Welcome to Market Movers. I'm Jim Uriel with Scott Martin.
Hi, Jim.
Okay, so in this week we've seen the trade war begin to escalate into a currency war. We saw China allow its currency to devalue. You and I both thought that the resolution was at hand weeks ago. Now do we throw that out the window?
Well, I think it depends on what you think a resolution is, Jim. I mean, a resolution to me today is that things don't get worse. It's not going to be the resolution we thought 6 months ago or a year ago. So to the point where you talked about currencies and the movement in, say, things like gold, yes, I would watch for those things to maybe settle down as an indicator that a resolution is coming.
Does the Fed have to respond to this new situation?
Our Fed should, Jim, because I think they're behind the curve. I mean, open market interest rates are leading the Fed down in rates, and all we've seen is one cut so far this year.
No doubt about it. Now, before we dive into our trade discussion, I'd like to point out these trades are examples, not recommendations or advice. We're going to be talking about the Euro, 6E, and gold, GC. Scott?
Yeah, I'm going to talk about Euro, Jim, because I believe that's a good alternative to just the volatility and craziness, let's say, that's going on in equities and fixed income, Jim. And looking at the Euro and just seeing some of the pressure on the currencies around the globe, especially, the dollar pulling back some here, believe it or not, even though it has been upward trending. There's something interesting, I think, going on in the 6E that's worth taking possible advantage of, my friends. So as an example, today I'm looking at buying the Euro Week 5, 112, 111 half put spread for 16 ticks. This trade risks 200 to make a potential 425. It expires on 8:30. Underlying is 1.1246. Now, here's the thing on the Euro and the 6E. If you look at the short-term linear regression lines, maybe the half-hour trades or the hour trades, those are actually hitting very near-term top resistance. The Euro failed at the previous two-day high on Monday, and so to me it looks like it could trade back to that maybe middle range of that linear regression area. It's already, like I said, at the top, and that's why I believe a put spread is a good way to express yourself as the dollar possibly rallies into the end of the month.
It's funny to me that we're talking about an easing Fed and potentially buying the dollar, selling the Euro, and I'm fine
like a sell
with
the news type of thing.
Because we're easy, they're easier. You know what I mean? They've been much more dovish than the Fed.
Absolutely.
They'll probably continue that. I'm looking at gold, and gold has had a huge run, up a couple $100 in what seems like weeks. So I'm going a less aggressive way of buying it than just outright buying it. It's a call fly. We've talked about this a couple times before. So it's the week 3, 1525, 1550, 1550, 1575 call fly for 2.8 ticks. So this is buying the 25 tick wide call spread and then selling the above 25 tick wide call spread where the two middle strikes are the same. So you pay 2.8 ticks for it. It risks $280 to make a potential 22.20. Now, people who trade flies a lot though know that the expectation should not be. It's hard.
Fair.
That's if it settles on that middle spot. So when you put on a call fly, what you're looking for is a solid appreciation, and then you take it off and look for the next opportunity. Do you like this expression?
I like this strategy and the structure. With the underlying around 1507 roughly in the October futures, Jim, gold just feels a little bit overdone, for me at least, as far as how everybody's watching gold now. Every morning somebody's talking about the move in GC. So that to me would just put a little caution in my hand with respect to short-term trading on gold.
I get that, and that's why I think if you get your pullback, all you lose is the 2.8.
There you go.
Right. Thanks for joining us on Market Movers. I'm Jim Uriel, where we are helping to make you a better trader.